Generally speaking, when you talk about specifically agency debt, which is what we primarily borrow, but I would say most commercial debt is this way. You get quoted a rate, but that quote is not an all-in rate. So the lender isn't saying, all right, I'm quoting you a 6% rate. What the lender is saying is, I'm quoting you to make the number simple, a 150 basis point spread above the 5-year Treasury, 5-year US Treasury yield, right? So that's their quote. They're not promising you an all-in rate of 6%. They're saying Treasuries today are 4.5%, and we're quoting you a 150 basis point spread on top of that, which just so happens to be a 6% rate. So if Treasuries go down to 4, you get 4 plus 1.5 equals 5.5. And that's how you can have the fluctuations through the time you get, between the time you get quoted and the time you lock. And like you mentioned earlier, it takes quite a while to lock an interest rate because there's a ton that goes into it. You have to get the legal all ironed out with the lender. You have to have the due diligence all ironed out. So the lender is going to order third-party reports. They're going to order an appraisal, an environmental, and a property condition assessment. And they can't lock the rate before all those things happen. And also, until your org chart is baked, until they approve of the major investors, the loan guarantors, they have to look at my bank statements, they have to check my credit, they have to do all these things. And then once all that is approved, the loan is fully approved, then we can get the go ahead to lock the rate. The reason why you have to go through all that and basically be ready to close in order to lock the rate is because locking the rate is not free. Because what you're doing is, because the lender doesn't want to take risk. The lender doesn't want to lock the rate and then rates go change on them, right? They don't want to take treasury risk just as we don't want to take treasury risk. And so what happens actually is there's actually bonds that are traded in the market in order to lock that rate. And so that way they're hedging out their risk. They're no longer taking that treasury risk anymore.